All right, friends, welcome back to Crypto Internet with Muneeb Ali, co-founder of Stacks, and Patrick Stanley, CEO of Freehold. Today, we have a fantastic speaker panel fired up to discuss native Bitcoin swaps. Now, if you're asking yourself, what exactly is a native Bitcoin swap? Well, so am I. I'm definitely new to this conversation, but from what I've read, we are in for a treat. This conversation is going to be so good and jam-packed, so I know you're going to have a ton of questions. We just ask that you save those questions until the end of the conversation, when Shannon with the Stacks Foundation will bring you up on stage to ask one by one. All right, Patrick, Muneeb, good afternoon.
Hello, Muneeb can lead in this one. Sure, happy to. I think we have two great guests here. Maybe I feel like most people already know them, but I'll let them kind of like quickly introduce themselves first. Dan, you want to go first?
Yeah, so a little bit about me. For those who don't know, been in the space for 9 years, worked at 5 different crypto companies, sold 2. I work at Kraken. On the personal side, I've written a lot of content on Bitcoin, and most recently started to dig into Bitcoin DeFi, which Stacks is part of that. So I'm on a multi-month discovery of learning about Bitcoin DeFi, and personally really fascinated with the idea of these Bitcoin swaps, or being able to kind of append smart contract functionality on top of Bitcoin without having to change Bitcoin. So I'm really thrilled for this topic.
Awesome. Scott, you want to go next?
Sure, guys, thank you so much for having me. First, I should say I come here more as a student and interested to hear what you guys have going on and to learn. I came into the space late 2016, and I came in strictly as a trader. So I've touched, most of the DEXs, AMMs, and have some solid experience with, comparable platforms that are not on Bitcoin. I'm very interested in hearing what it can do and discussing my experiences there as well. Funny that Dan and I are here together. It feels like we're dating. We spent the whole day together recording podcasts. Just before this, we recorded a podcast for my podcast. So hi again, Dan.
That's funny. Awesome. Let me set the stage with a little bit background and context here. So I feel like Bitcoin, everyone is familiar with Bitcoin. It's kind of like leading the charge in this crypto revolution. And it's really kind of like the only sound or sovereign money out there. And obviously, smart contracts are a very powerful concept. Ethereum kind of like pioneered that. We've seen a lot of kind of like interesting things that have happened since then on the smart contract side. But there seems to be kind of like this disconnect, at least in my mind, that we have the best form of money as Bitcoin. Bitcoin has the biggest brand name, the biggest community, the of a fair organic launch that happened, which is very hard to recreate in my view, right? Which are core properties of sovereign money. But it doesn't have smart contracts, right? And that's why we're seeing a ton of attention going to Ethereum, and now lately other types of layer 1 blockchains as well, because the demand for these smart contract type functionality is so much that even Ethereum can't really take all the demand. There's tons of interesting work on L2s in Ethereum for scalability, and there are next generation L1s like Solana, Avalanche, Algorand, and so on, that are also basically trying to absorb some of that market. And I think it's a very, very exciting time to be here. But the approach that we took at the Stacks project. So a little bit background. So we were Bitcoiners. I started the Bitcoin community in like 2013. And I was finishing up my PhD at Princeton back then, and over time, like we've been like kind of like hacking on Bitcoin over the years, right? With the idea of like we've been fascinating with what else can you build on top, right? Like it's a fascinating money there, but what else can you build on top? And the fundamental thing here really is that Bitcoin is valuable because you can't change it, right? And it is secure because it's very kind of like focused and limited at the base layer. It doesn't have a very kind of like large security attack vector, because it only does like one thing and does it really well, right? And it's a little bit of a paradox that how can you bring new functionality to Bitcoin without really changing it, right? And that's the technical puzzle that we've been trying to crack for a while. And I think like 2-3 years ago, I think we cracked the nut on it, built the public infrastructure and launched Stacks, which went live in January of this year. And the basic idea really at a high level is that can you have smart contracts as a separate layer right next to Bitcoin, like adjacent to Bitcoin, and then connect to Bitcoin and use Bitcoin for security. And effectively, these smart contracts can respond to Bitcoin transactions, right? So you could just make pure Bitcoin transactions and interact with smart contracts or do sorts of like interesting things there. And that's kind of like what we built, but it really kind of like came into focus with this idea of native Bitcoin swaps, which is, you know, a bunch of community developers on Stacks that they built that. And their idea is like pretty fascinating. Right? What they're doing is that they have created smart contracts on the Stacks side. So Stacks has full visibility into Bitcoin. And when you do a Bitcoin transaction, you're actually doing a swap between, let's say, Bitcoin and any other asset that can exist on the Stacks side. And because Stacks has full smart contract programming language, anything can exist there. Like anything that you can think of, like that can exist on Ethereum, anywhere else can exist there. So people have already built like, you know, NFTs. Stacks itself, the asset, is an interesting one because it yields Bitcoin. Or people are creating new things. We have Patrick here, who's one of the contributors and creators of the CityCoins project, and they have something very fascinating going on with Miami Coin. We can get into that. But if you're a trader and you just want to directly trade between BTC and let's say USDC, so USDC announced that they're launching on Stacks. Now you can make that trade with a pure Bitcoin transaction. Nothing else is needed. And I think that for me was like a mind blown type of a moment. Like imagine how much trade happens between Bitcoin and USDC on exchanges. I think the last time I checked, it was like $150 million of volume on Binance or Coinbase and others. And all of these centralized exchanges, we know the problems with them, right? Like you're effectively keeping your money on these exchanges. You're going through KYC. There's always this risk. Like I personally get worried like whenever I have more crypto on a centralized exchange than I would want to, right? And I want to kind of like take it off. Over here, there are no such limitations. You can have Bitcoin in a multi-sig setup, and let's say you want to swap Bitcoin into USDC. You can just do that with a pure Bitcoin transaction. And I think that was the magic moment for me. But I'll stop there and see what other people want to.
Yeah, Muneeb, can you kind of like walk us through, you know, like line, like not line by line, but like step by step with how that works? I know myself, but I think that others would probably like to hear that.
Yep, absolutely. So I think the way this works is that on the Stack side, someone is setting up the trade, right? So the Stacks layer has full visibility into the Bitcoin layer. So what someone is saying is that if you send me Bitcoin on this address, the smart contract will automatically release this asset. Let's just keep using USDC as an example. Will automatically release the asset to you if you finish this trade. You can even put a time limit on it as well, right? So it's actually creating like some sort of a marketplace for these swaps. And if you want to be a taker of it, right, you can effectively send that Bitcoin transaction to the right address. And I think what you're trusting is really important here, right? So what you're actually trusting, there's no company or third party in the middle, but you are trusting the smart contract logic on the Stack side. That if I make this transaction, the smart contract logic will automatically trigger and give me the USDC, right? And that's why I think we did a ton of work on the programming language itself. It's called Clarity, and it's different from Solidity. It is effectively a safer language, right? You can have mathematical proofs of correctness with Clarity, and I think it really plays a role here because I feel like the nature of Bitcoiners is that they don't want to trust it, right? So what you're trusting is a Bitcoin transaction and then a smart contract where you have mathematical proofs that this contract is going to execute correctly. and you will get the other asset. So the USDC that you're getting that on the Stacks chain. And now then the question would be, okay, what can I do with USDC there? You can cash it out, you can do other things and so on. So that's the type of trade you're doing.
Yeah, so like my understanding is, and what's kind of cool, I think kind of like the breakthrough moment for me of like this is like really interesting was Stacks can look at the Bitcoin blockchain, and when things happen on Bitcoin, that can trigger a smart contract logic on the Stacks blockchain. So you've got the USDC on Stacks and the Bitcoin on the Bitcoin blockchain, of course, and there's different conditions, and the smart contract is triggered based on activities on the Bitcoin blockchain. Is that right, Muneeb?
Yep, that's absolutely correct. So now, like, let's take another example. Let's say that someone wants to mint NFTs, right? Like, I'm not going to get into any discussion about are these things valuable or not. Like, for whatever reason, let's say people find them rare and they want to collect it, right? So people have created like a bunch of NFTs on Stacks already. But again, the unique thing there is you could actually tie the creation of these NFTs with Bitcoin. Right. So, for example, you can have let's say some of the traits in an NFT. Sometimes people try to make them unique by having a unique subset of traits and maybe tie them to block numbers. So you can effectively have Bitcoin block numbers automatically decide what trait is going to go on this NFT when it gets minted at a particular Bitcoin block. But I want to tie in the native swaps here. Because the interesting thing that the native swaps now enable is that even the bidding for these NFTs could directly be in Bitcoin now, right? So if you're a Bitcoiner and you just basically mostly want to deal with Bitcoin, you can actually buy assets like NFTs now with your Bitcoin never leaving the Bitcoin chain, right? So for people who are kind of like, hey, this stuff is interesting, but I am not interested in altcoins, or I don't want to go and buy a bunch of ETH and then try to kind of like participate in that market. Like, that argument pretty much goes away with these native type of swaps, right? Like, you can actually just purchase these assets. And at a more high level, I think that if I'm of the camp that sure, Bitcoin is great for holding, but the real value of Bitcoin is when it's used in trade, when it's actually deployed as a productive asset. When everything kind of like trades against it, Bitcoin actually becomes more valuable because it becomes a unit of measure for the value of different things. So I think if we can actually enable these native swaps directly at the Bitcoin layer, it opens up all of those possibilities of people actually using Bitcoin more to directly kind of like transact.
Yeah, so essentially, I'm moving Bitcoin on chain, and that's triggering different smart contract functionality. How does like the wallet architecture work? Like, just kind of to speak plainly for folks. So you have like a Stacks wallet, and you have a Bitcoin wallet, and the Stacks blockchain is looking at what the Bitcoin blockchain is doing. So you could send a transaction from your Bitcoin wallet to another Bitcoin wallet on the Bitcoin chain, and then you would have your Stacks wallet where you receive, XYZ asset.
Yeah, so I think the interesting thing here is that because they're very tightly integrated, so every Stacks address has a corresponding Bitcoin address. I'm actually going to take a little bit of a detour to explain another fascinating concept to people. So because every Stacks address has a corresponding Bitcoin address, you can even control the Stacks address purely through Bitcoin transactions. Right, and I actually do this all the time, and the reason was because there's such good support for multi-sig on Bitcoin that I actually felt better holding a bunch of my Stacks holdings just on a Bitcoin address, right? So I actually would rather do a Bitcoin multi-sig transaction on the Bitcoin chain, which is actually moving my Stacks on the Stacks side, right? So on the Bitcoin side, it's actually just moving a couple of Satoshis, right? But in the op return, it has the instructions that Stacks can read to transfer Stacks on the Stacks side. So that's actually pretty fascinating. If you think of like, if you view the Bitcoin layer as kind of like the source of truth and almost like the control plane, you can control actions on stacks just through Bitcoin transactions, right? Which I feel is a very powerful thing. And coming back to the wallet stuff, then on the wallet interface, you could your private key gives you a Bitcoin address, and it also gives you a stack address, right? And you can do certain actions on Bitcoin, you can do certain actions on the stack side. And stacks might be cheaper, right? Because the block space on stacks is way cheaper than Bitcoin. Bitcoin is precious, block space on Bitcoin is precious. So if you, let's say, don't want to do a $10 or $20 transaction on the Bitcoin side, or maybe even sometimes $100, you could do a cheaper transaction on the stack side to move certain assets, right? And over here in the original example, you would be effectively the person who is selling USDC, USDC would disappear from their stacks address, and Bitcoin would appear in their address. And from a UX perspective, this could be the same wallet, right? And so you're effectively feeling like, okay, I got more Bitcoin and I traded away my USDC.
Gotcha. And when we think about this from like a trading perspective, this is where I was excited to bring Scott up because he's got a bit more. I'm more of a hodler, so I just buy and hodl. So that's my primary trading method. But yeah, like I was kind of curious if there's like what's the application, and also by the way, can you give a brief? Muneeb, could you give a little bit of a brief, definite explanation of why you guys chose the word catamaran, which I actually find it pretty cool. But yeah, I'm curious about the applications. So Scott, after speaks, would love to hear a little bit more from you.
Sure. Yeah, I feel like some of the developers who actually worked on this, I don't know if Hiro or somebody else is there, they can be better at describing this. But my understanding is that the motivation for the name actually comes from the marine swaps that Lightning has. And because this swap technically has 3 steps, and one of them, it's basically there are 2 planes of it, right? There's the Bitcoin plane and the stacks plane, right? So the idea over here is that because you have 2 planes kind of like tied together, that's where the inspiration for the name comes from. For people who are more into kind of like water sports, would be able to relate to it.
Dan, to sort of touch on what you were saying, obviously as a trader, anything that removes friction, especially as an American, by the way, that's more decentralized and removes that third party, is obviously extremely compelling. But sort of a separate thought, Muneeb, something I wanted to ask you about. Obviously, in the news cycle of late, we've seen all kinds of forks and upgrades. London hard fork on Ethereum, we've seen price react favorably to that. Obviously, the announcement of the Alonso hard fork on Cardano that's eventually coming with smart contracts. And I feel like the upgrade that's been sort of buried in the news cycle is Taproot, obviously coming in November, which is bringing smart contracts to Bitcoin. So I'm curious how that functionality, how that upgrade will affect this, if it will make it easier for you guys to function, for us to use stacks, or how that will affect it.
Yeah, I think it's a great question. So I think in general, Taproot is great. I'm a big supporter of it, especially like it helps with saving space on the Bitcoin chain, and also making a bunch of privacy improvements, right? So effectively what happens is that if you're doing kind of like a more complicated transaction on Bitcoin, people can actually see that this is a more complicated transaction, right? With the Taproot, it would become harder to do that. So you can actually have more complicated script, multisig and other things, and they would actually cost less on the Bitcoin side. And people wouldn't be able to distinguish between kind of like a normal Bitcoin transaction versus the more complicated transactions, which is great. I feel like the fundamental difference, and this is often, I think, a point of confusion that I've seen in the Bitcoin community, is that sometimes we'll talk about smart contracts for Bitcoin, and people would point to things like Taproot, which actually helps. Like Taproot is not introducing a new programming language; it's basically making existing script or more complicated scripts a little bit more efficient. But then it opens the door for additional things that people can potentially build there. But then people would point to things like, DLCs, that, hey, DLCs are a way to do smart contracts, which they are. Or they would point to, I think there's some initial work on things like RGB, which is a programming language on the Lightning side, so that you can do some interesting things with. Right. So I don't want people to get me wrong. I'm super excited about all of these things like DLC, RGB, all of that. But I feel like in the high level discussions, people kind of like classify them, right? Because you would see somebody talking about that and they would say, oh, but you could just do smart contracts on Bitcoin by using DLCs. But DLCs are a different type of a smart contract, right? Like the big difference there is that it actually, you're limited by Bitcoin script, right? That's the fundamental thing on the Bitcoin side, that Bitcoin script itself is limited, right? So anything that you want to do, the space of possibilities is limited if you're limited by Bitcoin script, right? And then you can do certain things offline, which is what DLCs do or RGB would do. But then there are two kind of like downsides to it. One is that it often requires coordination, like off-chain coordination between the parties who want to participate in a smart contract, which in theory might be like, okay, sure, you can do that. But I think practically is actually a pretty big challenge, right? The purpose of smart contracts is that trustlessly you can just, like let's say you want to do a swap. I don't want to talk to the person I'm doing the swap. I just want to like send a transaction to a smart contract and do it. Whereas in DLCs, you would actually have to somehow establish offline communication with that party that you want to do a transaction with. And then in certain cases, even compute possible outcomes, right? And then there's a ton of complexity involved with that, right? So the benefit is that, hey, you're not modifying Bitcoin at all, and you're just using Bitcoin script. And but the downside is that you're adding a lot of complexity and offline coordination, which is sometimes like a non-starter for a lot of the use cases. And then secondly, and this is a very important point, that these types of contracts don't lead to they don't have global state, right? So they don't have global state, and they don't have this network of contracts that are deployed offline, right? And this was the powerful effect that we saw on the Ethereum side, where once Uniswap is built and Uniswap is actually deployed, people can actually build other things around, right? Or if Aave is deployed, you can start connecting the Lego blocks of DeFi, because these things have global state and they are network and they're online, and they are these DeFi primitives that now you can mix and match and do other interesting things with. So that you cannot do with the DLC type approaches, because there's no data on chain, right? There's no global state. There's no kind of like smart contract that is just online and you can just call it and get a response. So that was the core reason. So these things can find use cases in other domains, right? But if you're looking for Ethereum-like functionality, if you're looking at like automated market makers or lending protocols and the type of functionality that we're kind of like used to in modern DeFi, you need to have a fully expressive smart contract language like Clarity, and you need to have some sort of a gas asset that gets consumed when a smart contract is executed. And I feel like this is like such a fundamental roadblock for a lot of people in Bitcoin. And I completely sympathize with that, because as soon as you say, hey, there's an alternative asset, alarm bells goes off, right? Like, because they've been burned in the past with so many scams and so many kind of like strange projects, just effectively trying to like raise money and scam people. But it is a fundamental trade-off that if you want to have these global state, always on type of contracts, then there needs to be some sort of a gas that gets executed when you do that. You could technically do that with Bitcoin, but then you'll have to modify Bitcoin. And that is a stuff that I don't think a lot of people are willing to make. And I think that's why we landed with the Stacks design, where Stacks is a separate layer with its own gas asset, but it has like full Ethereum-like functionality, which you wouldn't be able to have without the gas asset.
And I'm curious, for traders down the road, obviously, we're seeing the first iterations of what's possible here. Do you see being able to build AMMs with more robust, like familiar order books, things like that people are used to on centralized exchanges that can be enacted on decentralized exchanges via Stacks on Bitcoin?
Yeah, absolutely. I was actually very pleasantly surprised by how many teams are already doing it. But Patrick, correct me if I'm wrong, or if there are other community members here. I believe there's one project, it's called Swapper, that has built a Uniswap style automated market maker. There is Arcadico Finance that is launching. They are starting off with a stablecoin, like an algorithm-based stablecoin, but also getting into like lending and those sorts of things as well. And there's another decentralized exchange that I believe even went live like 2 days ago or something. I haven't personally tried it, and I'm aware of one other team that is it's not public yet. That's also working on a DEX. So I think like that's the fascinating thing. Like as soon as you give people like these fundamental building blocks, the developers are already starting to build these primitives, right? And very soon, I think we'll have these types of automated market makers online. And the interesting thing over there would be that then you would be talking about, like, imagine if right now you want to go and participate in some sort of trading. It's very hard to use Bitcoin directly. Like you'll have to go through some sort of a wrap asset and wrap assets are usually custodial, or you have to go through KYC or have the weird tax issues with them both ways. And over here, if you, let's say there's the AMM and you want to do trading there, your first hop could actually be a native Bitcoin swap, right? You could do BTC to USDC and then USDC to some other trade, and then back if you want to take your profits out and you want to keep, like, let's say you're one of those people like Dan who want to basically keep Bitcoin, right? Like then you always take your profits out and you swap back to Bitcoin.
And what's obviously interesting there for anyone who's super anal about security, like I know a lot of us are, is the fact that you could do this via multi-sig, right? To me, one of the biggest risks, and listen, everybody I think knows that I'm a fan of Ethereum. I use a lot of these AMMs and platforms, but it'd be very compelling to be able to do this for multi-sig with the security that I have with Bitcoin, which is something that really has not existed previously, right?
Yep, that I think it's not just the security of the multi-sig, it's the full backing of a mature industry, right? Like imagine that the amount of capital that is being kept on Bitcoin multi-sigs is at this point, like it's probably the best, right? Like you can't think of anything that is more hard-earned and tested. And as I shared earlier, like I even keep my stacks on using a Bitcoin multi-sig. And the right. the fact that I can do that, like, actually helps me sleep at night, because I have all my Bitcoin holdings on a exactly similar type of a setup as well. So it's the same level of security. And I think you can't get that with some of these other L1s, because when you're going to those L1s, the first thing is going to be, okay, like what type of multi-sig support do you have? Like how many assets am I really willing to kind of like risk by some sort of a new wallet and new setup?
Outside of Bitcoin and stacks, are there others that you'll be able to send to the same address and hold within multi-sig?
Yeah, so the stacks address works exactly like a Ethereum address, right? So it can actually hold all sorts of other tokens. I've been actually mining Miami coin for fun over the past week. Actually, maybe let's pull Patrick in and maybe you can update people on what's been going on there.
Yeah, Patrick's going to kill me because we met on this and I haven't started yet.
Hi, and also we have Mike Sarasti, who's the Miami's CIO, who's in the audience right now. So essentially, a couple of things. First is Bitcoin really is operating like this prime mover, like this big gear that powers other gears. That includes things like these token standards that have existed on stacks, like Miami Coin, which is a SIP010 token on stacks. So like you can do, just taking a step back, you can do Catamaran swaps between Bitcoin and Miami Coin, for example. I'll get into a little bit about Miami Coin in a bit, but it's not just Bitcoin swaps with stacks and Bitcoin, it's any token that's sort of built on stacks. You can just do a simple Bitcoin transaction and then the swap has been made. So someone's already done this. There's a video up maybe from like a week or two ago @MineCityCoins, at MineCityCoins, the Twitter handle. Even more interesting is that with CityCoins, what CityCoins is essentially like open source protocol for developers to build applications for city-based tokens, and roughly 30% of all the sort of mining that happens that is generated on these respective cities sort of protocols is sent directly to a reserved wallet for the city. So like, for example, Miami just crossed $2 million worth of Stacks tokens that it's earned from hundreds of miners mining Miami coins. Miami coin, just for record, is like open membership mining token, no pre-mine, no ICO. Anyone can mine it by forwarding Stacks. And what was interesting is the reserved wallet that's currently being custodied by Casa, which is like a cornerstone Bitcoin multi-sig wallet. I think they have like $3 billion assets under management under custody. So the city's reserve wallet is essentially custodied via a Bitcoin multi-sig wallet by Casa. So like, it's not even a Stacks wallet. It's not a Miami coin wallet. It's literally a Bitcoin multi-sig wallet, and that's nice. Like, from like a, if you're thinking about it from the perspective of many cities around the world wanting to launch their own city coin and get the benefit of having their own open protocol and their treasury building, their treasury sort of growing over time. Sort of like what better system to build on, what trusted system to build on than Bitcoin, and what better sort of multi-sig support to use than Bitcoin. So that's a little bit of a broad stroke of what's been going on recently.
Yep, that's super interesting that the city's treasury is kind of like using a Bitcoin multi-sig as well. And obviously, I think what's interesting for me over here is people are experimenting with all sorts of new crypto assets, mostly in Ethereum, but also now on the new L ones. But over here, because of this native connection to Bitcoin, if someone wants to create these assets, like great, they have the freedom to do that. But you do get, the security where you can have a Bitcoin multi-sig wallet and then secure your assets that way. I think it's going to be especially attractive for people who hold a lot of USDC or Tether. Right? Like once those things are established on the Stack side, keeping these things on a Bitcoin multi-sig and using things like Casa and others could be very interesting. But I want to point out one thing about these new assets is that because Stacks itself is a Bitcoin yielding asset, these new assets can also have very interesting connections to Bitcoin. Like I was discussing NFTs earlier. There are people who work on NFTs where your NFTs can actually earn a Bitcoin yield. Like obviously there's Stacks involved in the middle, but it could be hidden away as well, right? So the users are effectively just experiencing a Bitcoin yield. Similarly with these city treasuries, it could be, at least for me, super interesting where the city is mostly interested in the treasury because of the Bitcoin yield, right? So what Patrick mentioned that even in the last 2 weeks or so, the city treasury now has like $2 million worth of assets in it, but they can earn a 10% Bitcoin yield. And I think for people who are really forward thinking, and instead of consuming your treasury and selling your treasury to use in whatever ways you want to, you might just want to park it to earn the Bitcoin yield. And Bitcoin is like such a valuable asset to earn that it just makes a dramatic difference in how you even view the Bitcoin yielding asset. Like Bitcoin is so valuable that in my mind, the Bitcoin yielding asset itself becomes valuable. Like that's just me, but I think I find that part super fascinating.
10% Bitcoin yield is astounding. How is that facilitated?
Yeah, so that's actually I feel like a ton of work has happened on the Stack side, and not a lot of people know about it. I think it might be because of the early folks who kind of like got attracted to the project and built it out, they're pretty much like, computer scientists and engineers and geeks who just like building things with them and not talking about it that much, right? So imagine like in the last few months, people have earned north of $25 million in Bitcoin yield. And I think it's still not that well known of a thing, right? Like not a lot of people are doing that. And the way this works is that it's actually a breakthrough consensus mechanism. It's the consensus mechanism that the Stacks blockchain uses. Right? And there are a couple of unique things there. One is it's the first consensus mechanism that is between blockchains, right? So the bulk of the consensus actually runs on Bitcoin, and then it kind of like connects to the stack side, and that's how we secure the stack chain. But the second kind of like innovation there, so the first one is that it's secured by Bitcoin. Like Bitcoin is the most secure blockchain, and this consensus effectively connects a separate blockchain to Bitcoin and secures it using Bitcoin. That's number one. Number two, interestingly, is that whenever you're kind of like starting a proof of work type of a blockchain, you're always destroying value. Like so, in Bitcoin's case, you're burning electricity and then minting new Bitcoin. We actually cracked like this algorithm where you don't have to destroy value, but still get proof of work like security benefits, right? So you can even think of that as a recycled proof of work, and that's how the Stacks chain gets secured, right? So what happens is the Bitcoin miners are burning electricity and mining Bitcoin. Then Stacks miners are using that Bitcoin on the Bitcoin side to basically spend it and secure the Stacks chain. So there's an inflow, like just like electricity is going into the Bitcoin ecosystem, Bitcoin is going into the Stacks ecosystem to secure it. But instead of destroying the Bitcoin, that Bitcoin is distributed to the people who are actively locking up their capital. And that's where the yield is coming from. I think the analogy would be if you were a Bitcoin holder and you were getting like electricity sent to you because you're a Bitcoin holder. I think obviously that's a weird analogy, but that's kind of like what's happening. That because you're a Stacks holder, you're getting like Bitcoin sent to you, and those Bitcoin appear in your Bitcoin wallet directly as a Bitcoin transaction, and that's the 10% yield.
Let me see if I can summarize it, because it took me a little while to get my head around this. Essentially, you've got Stacks miners that bid to win a Stacks block, and they bid by sending Bitcoin to an address. And essentially what the Stacks blockchain is doing is originally was a proof of burn mechanism. So the Bitcoin that would have been bid would have been formally sent to a unspendable output to where it burns the Bitcoin proofably. But instead what the Stacks team or what the Stacks ecosystem did is they took, instead of that proof of burn, they used that to redistribute that Bitcoin to Stacks holders and to throw off that Bitcoin yield. So it's like kind of like an incentivization method for folks to want to hold Stacks. And to be clear, I'm still a Bitcoin only sort of guy, but I thought that was pretty innovative in terms of like, otherwise, instead of just burning the money, so proof of burn, instead of doing that, it's more of proof of redistribution. And so I thought that was a really kind of novel way to tie those two together.
Yep, that's exactly how it works. And for people who are more in the weeds with mining, like imagine that how the Bitcoin miners are calculating hashes, right? So your probability of winning is tied to like how many hashes you're calculating. If you run a lot of competitions and you do a lot of hashes, you have more slots of winning a Bitcoin block. So over here, we have replaced the hashes with Bitcoin bids, right? So if you're bidding with a lot of Bitcoin, you have more slots. It's still a random probability, but you have basically more higher chances of actually being one of the slots that actually wins the block reward. Right? So we have replaced the energy consuming portion of calculating hashes with effectively just bidding with Bitcoin. And then miners are becoming very sophisticated. Right? Like they try to, just like Bitcoin miners try to maximize their profits, the Stacks miners are basically trying to maximize how to spend the least amount of Bitcoin and maximize their chances of winning a block. And that's how it works.
Great, we've got a few questions. Are we okay to start that session?
Yep.
Cool. Wall Street Bets, the floor is yours. Go ahead with your question. I think they're connecting. Wall Street Bets, you there? Going once?
Might have to hit the mic button if you've never done this before. I've been there.
Give them a sec.
All right. Timothy, do you want to go ahead with your question? Timothy, go ahead with your question.
Like Twitter Spaces still has some things to work out.
I think it does, yeah. Timothy or Wall Street Bets, you can go ahead when you're ready. In the meantime, Andrew Wicklander, I've invited you up.
Yeah, hi, thank you. So just a quick question about the mining of the CityCoins. So does that work in the same way as the stacks mining, but the miners are sending stacks to mine the CityCoins? Is that how that works?
Yeah, that's correct.
Oh wow, okay. Wow, cool. Thank you.
Yeah, I think of that as like, Bitcoin mining is actual like hardware, physical world, right? And what we did with Stacks was we turned it into a software only thing. But once it's software only, then you can just repeat it, right? You could do it once again in software, and that's what people are doing. Have started doing already. Right?
So wait, so could I buy Miami coin and then stake the Miami coin and earn stacks?
Yes,
That's right.
It's also correct.
What, really?
Yes.
Wow. Okay. Ha. Thank you.
And you can take those stacks that you earn
Yeah, I know.
and stack that and earn Bitcoin.
This is like Inception a little bit. Okay.
Wow. It's like imagine like essentially like terraforming Bitcoin with a bunch of utility and
Yeah.
the whole system. You're essentially like you're recycling proof of work throughout the whole ecosystem.
Right.
And the interesting thing is, it's all measurable. Like because the way proof of transfer works, or you could call it recycled proof of work works, there's a trading pair that's established every 10 minutes. So every 10 minutes, you can get a sense of what the trading pair is between all those tokens that are using recycled proof of work in real time,
right,
without any exchanges needed. So you're like pricing the whole ecosystem in Bitcoin at all times.
So I just want to make sure I understand. And then I think I heard Muneeb say that your Stacks wallet also can hold your Miami coin or other CityCoin projects that come about.
Yeah.
Is that a correct understanding?
Yeah, so the Stacks web wallet, it's been really good. Like it really feels magical. Yeah, you can stack through the Stacks web wallet. You can mine through it. You can transfer through it. You can do these Catamaran swaps between BTC and MIA trustlessly. So it's like
Great.
Like as a user of Miami Coin, I'm super grateful that the web wallet exists.
Yeah, and I think this thing is just super interesting that the value of something is actually being measured against Bitcoin, because Stacks is being created because people are willing to kind of like bid in Bitcoin, right? So there's a native price pair that anyone can actually see on the Bitcoin blockchain, really, that this is the price that people are willing to pay for this asset. And then you can go one step further for something like Miami Coin or other things. Then there's again a price pair that people are willing to do, and you can convert that into BTC. So with any of these, in this view of the world, you don't have other separate blockchains, but Bitcoin is in the center and interconnecting to Bitcoin. But the value of those assets is really represented in Satoshis, right? Like this is the value of this asset because of the native price pair against Bitcoin.
Thanks so much for taking my question. I appreciate it.
Great. Mohammed, do you want to go next?
Yes. Hello, Muneeb. I just need to clarify something about from the technical perspective, because some people I see some messages, some tweets that trying to do a comparison between the proof of transfer in terms of mining. So you need to, as you mentioned from a while, that you need to bid as much as higher to increase your probability of mining a block. So some people trying to compare between this concept and the concept of proof of stake consensus algorithm. So how we can differentiate between both, while from the different perspective, they say that maybe it is similar.
Yeah, no, that's a great question. Right? So I feel like there's a huge difference from proof of stake here, right? So I feel like Dan has written some good content about this as well. I encourage people to check that out. But in proof of stake, I think one criticism that people have is that it's a mechanism where the rich kind of like get richer, right? So you already own a lot of the coin, and now you are the miner, right? You're the miner because you already own these coins and you're earning more on top. That is not the case over here, right? So miners are separate from token holders, which I actually think is very important, right? Like think of that as like, I know the US government is, especially these days, is not a great analogy, but the government is functional because it has independent checks and balances, right? So miners are an independent party in Bitcoin, where it doesn't matter if a miner owns a lot of Bitcoin, like you can come in and you are willing to spend resources and you're willing to compete in an efficient market to try and earn Bitcoin. And I think that's exactly the case over here, where if you own a lot of stacks, that doesn't really impact your ability to be a miner. The miners over here are doing a very different calculation. The miners are looking at how much money is coming out every block. What am I bidding against, right? And then they can decide if they want to bid more or not, right? And which is very similar to Bitcoin miners. Like at some point, they have to calculate like how much computation they want to do in order to kind of like try and compete in the lottery. Right? And the verifiable random function that's designed, it's actually designed in a very clever way that if you just start burning Bitcoin like crazy, like there's no guarantee you're going to win. So it's not a rational approach to actually bid too high. You really have to like do some homework and figure out like what's the optimal level at which you want to be bidding, given the VRF, the way the random function is working. Right. So yes, you have higher chances because you're effectively you have more slots in the lottery, right? But there's no guarantee. So it is still a probability.
Yeah, a good way to think about it is like proof of stake is showing that you could potentially burn money. It's like showing that there might be future consumption versus proof of burn and proof of work, which is like consumption was proven. So either the creation of Bitcoin, proof of work, so taking electricity and outputting Bitcoin, or stacks where you provably take Bitcoin and use that as a like a proof of burn mechanism. So I would say like it takes real costs versus proof of stake, which requires no real costs. You just posted collateral as a potential future cost if you behave improperly.
Yep, that's a great way to think about it.
Great. Timothy Allen, do you want to go next? Okay, we have Nasir connecting. Nasir, go ahead with your question.
So, did you call my name?
Yes, go ahead.
Yeah, thanks, Muneeb, for taking this. I really like the architecture. One thing I actually was also wanted to discuss about mining is So how decentralized is that? And I mean, what is the APY for mining? Because this is something I've realized it's discussed very little, in the sense that what are the incentives for the miners to do mining on Stacks blockchain?
Yep, I think that's a great question. So in general, I would say the incentives are very similar to any blockchain, right? Like there are typically two parts of it. One is the what's called the coin-based rewards, which are the newly minted tokens that are coming online. So same for Bitcoin. Bitcoin has a certain schedule of newly minted tokens that come online. And then the second part is the gas fees, right? The transaction fees. So we've seen like how much gas consumption actually happens on smart contracts that become popular. Like we've seen, stats from Ethereum recently, where things like OpenSea or Uniswap or even games like Axie Infinity, they're doing some serious volume just on the gas. And so if you're a miner on Stacks, given Stacks is recent, only launched I think this January. Right now, the bulk of the rewards are actually the newly minted stacks that are coming online. But there are some gas fees, and the my hope is that the gas fees would actually be much more significant down the road. And interestingly, the way the system is designed, if let's say there is a Axie Infinity type of a game that's taking off, or a automated market maker that is now resulting in a ton of transactions on the Stack side. Interestingly, what that does is the Stacks holders would then be earning more Bitcoin, because now the miners have to bid more Bitcoin because there's more money on the table per block, right? The gas fees just add to the pile of money that's up for grabs. And then miners are actually, so the throughput of the system actually goes up, right? And in terms of decentralization, this is again a very interesting point where maybe it helps to like make a little bit of a comparison, like what's happening in the broader Bitcoin ecosystem. Liquid, for example, is a awesome work by Blockstream and has really targeted use cases. But Liquid is a federated system, right? And because the way it's designed, it is a federation. You have to kind of like trust the federation to run it. Whereas Stacks is actually a fully permissionless system. Like I absolutely understand that the new gas asset that it introduces is potentially problematic for diehard Bitcoin fans. But if you think about what the new asset is doing, it is actually adding a value that a lot of Bitcoiners really like, right? So they don't like federations. They do like open permissionless systems. And the reason why Stacks mining is open and permissionless, anyone can be a miner, is because of the asset, the separate asset that is up for grabs. Right? So I think those are the way to think about these things, and these are all trade-offs. Like we could have built a federated system and not have open mining, like, but that's not that kind of like kills the purpose. And we opted for having open permissionless mining, and that's why the reward mechanisms are designed this way.
Great. Crypto trader Forez, your turn. Okay, we also have I am Rohit Kejan. Your turn.
I'm a latecomer. Can I please ask if you have any guide that we can read after the session?
Yeah, the video will be posted to Stacks YouTube after this session.
And I think there's a blog post that's linked at the top that could be a good guide into the native Bitcoin swaps as well.
Great. We have just a few more minutes left. Crypto never sleeps. Go ahead with your question.
I have a question for Muneeb. Thank you for organizing this. And the question is why we need Blockstack token of 90,000 in order to stack it. Why not less than 1,000 people who can stack?
Yeah, I think that's a great question, and I think basically when the protocol designers were basically trying to design this, it's a Bitcoin bandwidth limitation. Right? So we actually even looked at Lightning channels that could be distribute Bitcoin over Lightning channels and then we would have a lot more bandwidth. Then we're not kind of like messing up the Bitcoin bandwidth for this. But there are other types of complications that get added if you have Lightning in the mix as well. In a consensus algorithm. Consensus algorithms are already fairly complicated. Throwing in additional complexity is actually probably not the right thing. So let's say that we are now limited to Bitcoin. We don't want stacks to consume, let's say, 50% of the Bitcoin bandwidth. Like that I don't think would be a good outcome. Right? So we wanted to not exceed a certain percent of Bitcoin bandwidth per block, because these miners are going to try and mine aggressively, and then the number of payments that are going out to people, that directly impacts the bandwidth. Let's say that, so something like, I think 350,000 unique addresses hold stacks. If we want to send these payments to like so many addresses, you can imagine that we can potentially clog the Bitcoin blockchain, because this is happening on a per block basis as well. So that's where the limitation comes from. We picked this magic number for 4,000 slots. So effectively, there's a dynamic adjustment of the minimum threshold. So it's somewhere between 90,000 stacks to 100,000 stacks typically. It's because you're getting one slot of payment based on that lower bound. But then people have built pools, right? So if you go to these community pools, like a Figure is running one, there are a bunch of others, Xforce, a Hong Kong-based company, they're running one. Then you're just behind a pool, and it doesn't matter. This threshold really doesn't apply to it. Same with exchanges. I think OKCoin is doing this, OKX is doing this, a bunch of other exchanges are just running pools. Obviously, a community pool is better because you can delegate to them and not actually transfer your money there. But if you feel comfortable using OKCoin and you like this guys, they're doing a great team. People are participating through places like OKCoin exchanges.
Great. Tommy Porter, last question.
Hi, could you just speak a little bit to the roadmap with Stacks 2.1 hard fork as far as the timing or launch, how that may affect these Catamaran swaps, and any other kind of key new features that'll be happening?
Yeah, I think before I comment on that, I want to highlight one thing that in this project, like other than kind of like given that we're Bitcoiners and we are building around Bitcoin and so on, we wanted to be very careful about true decentralization as well. Like in the early days, like before the mainnet launch, obviously my company did a lot of R&D work. We did a lot of infrastructure building. But with the mainnet launch, we truly decentralized as well. And that is something I'm very proud of. Like, I think right now there are more than 30 independent entities in the ecosystem. My company, Hiro, that did the early R&D, now basically build developer tools, right? So I can tell you the upcoming quarters roadmap of like my company. But my company would be something like Blockstream, right? But there's actually no like global roadmap, and in some ways, like it could be a potential downside, because I know there are crypto systems that are very heavily centralized, and our company is really running forward with them, and they can put out roadmaps, but that's not really what's happening, right? But I actually truly believe that that's a strength. That while you might not find a global roadmap, all these different companies are doing different interesting things, and then people can like organically put things together to see where the project is generally going. But that said, I think my latest understanding that the 2.1 is these native swaps are not impacted by anyone. I think there are some tweaks that I've seen, like some ways of making these transactions more efficient. I mentioned that technically 3 transactions happen for a swap, but maybe could be reduced to just 2. So that is the only link. Otherwise, like a swap is a swap. People are willing to kind of like pay a fee and even broadcast these transactions in one go and so on. And otherwise, I think 2.1 would largely be dependent on miners. But in terms of development, my guess is like looking at open source code, like it's something like 2 to 3 weeks out.
Great, thank you.
Great. I know we're at time. Muneeb and Patrick, any other questions on your end? All good? Okay.
No, I'm
Thanks.
all good. I feel like we had such great guests and we didn't get to hear from them that much, but I think I would go and maybe listen to the podcast these guys were recording.
That'll be in a week or two. But we'd love to have you as well, but you. Thanks
Yeah,
for having
I
me, guys.
I'd love to. Let me DM you.
Scott and Dan, where can people find the podcast? Just on your handles?
It'll be out probably in a week to 2 weeks. We just recorded it today, but yeah, you'll be able to find it on either of our handles. This is our round 2, so you can look up the first one. It's pretty epic.
Can't wait. Thanks so much. Frankie, go ahead.
All right, friends, if you're not bullish about stacks, CityCoins, Bitcoin swaps, and overall DeFi on Bitcoin after this conversation, what more do you want? Right? If you have suggestions for future crypto internet shows, please DM us and feel free to pitch us. For now, we're off. Join us next week, same time on Thursday, where we'll bring on more founders talking about people building great projects and answer all of your questions about the Stacks blockchain, Bitcoin, and of course, BitFi, a little play on words for decentralized finance on Bitcoin. Have a great evening, everybody.
All right. Thanks, everyone.
Thanks, everyone.
Thank you. See you.
So.